Hello, everybody, and welcome to my new series that I call the Debt in the 2020s series. So, in this video, I want to address the question, what is debt and where does debt come from? And in this series, I intend to read a disclaimer for everything I say in the series because I think there's so many misconceptions about money, so many disagreements, etc. But I think it's important that I lay these things out there and tell you a little bit of the background behind the series and why I'm doing this series. And so let me just go through a disclaimer before I start talking about debt and money and what this all is. So first of all, the topic of debt has fascinated me since 2014. 14. I fell down this hobby, this rabbit hole, when I first dabbled into Bitcoin. I guess, an early adopter of Bitcoin, and then I sold it. I sold it in 2015, and this is a very common story. And I got out, and then I got back in years later, realizing that I was right all along. Because whenever you talk about money, there's like so much doubt, like so many people are gonna make you doubt, and I'm sure these videos are probably gonna get the most amount of dislike. But that's okay. That's okay because this channel is named the Beat the Denominator channel. That's a channel about money. I want to talk about as much about stocks as I talk about the denominator itself, which is the US dollar. We have to talk about the US dollar. But when you talk into the US dollar, you get into different fields of academia that disagree with each other. You get into different theories. You have to talk about economics, etc. So um, first of all, so that you know where I come from, I come from the world of Bitcoin. That's how I got fascinated with money. And I think most people, when they analyze stocks, they miss the other part of the equation, which is what is money. And there's entire YouTube channels, there's entire publications, debates, conferences debating that very topic of what is money. My view of money, and this is my opinions in this video, my view of money is seen through the lens of both Austrian economics. So the economics who follow the gold standard, right? Lots of gold standard thinkers in Austrian economics and engineering. And I think both are very important to understand money. And I believe that money should not leak. So many of the problems that we have today is because money leaks. Money should not leak. Money should follow the first law of thermodynamics. That's the engineering concept of money. And we've never had money that doesn't leak. The closest we ever had was gold. Hence why central banks use gold as their reserve currency. And I think we have the first money that doesn't leak, which is Bitcoin. Bitcoin doesn't leak. And the topic of money has been debated for millennia. It goes back to the era of Rome and coin clipping. This topic has been debated for forever, for millennia. And just know that even the biggest experts in a same movement have plenty of disagreements and different thoughts and views. So my goal is just to share my views with all of my channel. And if you disagree, that's okay. That's okay. You don't have to watch the money series. We can just talk about stocks. If you don't have to agree. And by the way, my opinions are very fluid on this. Like it's strong opinions, but if I see facts change, I will change my facts. And that's a journey. Learning about money and the true nature of money is more of a journey than it is anything else. And nonetheless, I try to understand money through the lens of hard science. To me, money has to be a hard science. It has to be a science that follows engineering, and not a social science like it is today. And now that I've put that out of the way, let me tell you a little bit about what debt is and where debt comes from and why it's so important to talk about debt. And that's why we talk about the series Debt in the 2020s series, the name of the series. So, what is debt? Let's talk about debt. Well, debt is money that you get today and you promise, keyword here, you promise to repay it later. Now I say that's a keyword, right? Because do governments repay their debt? No, they don't. They roll it over. Do companies repay their debt? No, they don't. They roll it over, right? Most of the time, they roll it over. So let's be very careful. But in theory, it's a promise to repay. You're supposed to repay your debt. And this is how debt is supposed to work, or at least if you're just starting out in finance, you probably think debt works like this because it's logic, right? In a fixed money world, so in a world where money is hard to create, and I'm going to insist a lot on the word hard throughout this series. In a world where money is hard, the funds would usually come from a saver, from someone who has saved their hard-earned money, um, and you would borrow those funds from a saver and pay interest to this saver. And of course, if you operate under a Bitcoin standard or a gold standard, and by I mean Bitcoin standard and gold standard, I don't mean paper gold or paper Bitcoin. I mean final settlement, i.e., you have the keys in your head to your Bitcoin and you have the gold in your hand. Talking about holding the asset. In this idealistic world, if you have gold coins, you would lend your gold coins to someone and then get them back over, say, 5 years with interest, with a little interest. And that is the way it's supposed to work. Now, of course, very, very, very few people ever do that. It's so risky. Like very few people would ever do that. That's why so few people save. That's why most people invest. Because we inherently know that the rate of return that we would need to get on money that we give up today to get back tomorrow, that rate of return would have to be much higher than a savings account, much higher than 3 to 4%. Actually, the natural rate, the rate at which in a fixed money or hard money standard, the rate at which you would lend money would probably be pretty close to 15%. It would be somewhere in the teens. And it's not like that. So moving on, how does it work? So this is the ideal world. This is the fixed money world where you have someone actually give up something in exchange for interest. In the Keynesian world or the fiat money world, here's how it works. When you borrow money from a bank, that money is digital, right? It's paper money. It's the same as paper gold or paper Bitcoin. And gold, loaning really started in Italy, in Florence. That was all about paper gold. Once you have paper gold, it's easy to print a new piece of paper that says you have gold. So this is the same concept in Keynesian economics. So fiat money is what? So when you go to a bank and you say, I want to borrow $300,000 for buying a house, I want to borrow, this is going to be my mortgage. What does the bank do? Well, the bank simply writes on a ledger, and this happens in a much more complex, shadowy way, but the rationale is the same. The bank puts a dollar amount on a ledger. Say, oh, we have lent money to that person. And when you repay that money, the bank erases that amount of money from that ledger. So when you borrow money, it's new money creation. It's created out of thin air. The commercial banks write it on a ledger. And then when you repay, they just erase it from the ledger saying you've repaid. And they charge you an interest rate. Why? Because the interest rate covers two things. The interest rate covers the risk of no repayment. So if you don't repay, well, the bank is in trouble because they wrote all of this money. They now have to erase it because they're never going to get it back. So that erasement of previously landed money from their books is a loss to them, and so they have to cover that loss. So that's the interest rate. That's the bulk of the interest rate goes to that. And then they have a margin, small margin for the bank. And that's a very simplified framework. You also, of course, have a federal Fed fund rate that's added to this because banks typically have their money overnight at the Fed. But that's for a more in-depth conversation. I really want to focus on the mechanics. So money, dollar, US dollar, fiat money, is created out of thin air. It's by the banks, by the commercial banking system. It's created out of nothing. How does it work for governments? Well, for governments, it works a little different. For governments, first they create a deficit. So hopefully they wouldn't have to create a deficit. But if governments want to borrow, they have to have a deficit. And second, they sell treasuries, right? Your government bonds. And third, anybody can buy the treasuries, oftentimes foreign nations. But if not, and right now more than ever, there's fewer buyer of these treasuries, then it's the Fed that has to step in and buy the rest of the treasuries. And the Fed buys these treasuries, which finance the deficit of the US government. They buy these treasuries with newly printed digital money. That's called base money. The money is printed. And if you look at the 60 Minutes interview of Jay Powell, he exactly says that. He says it straight to the reporter who doesn't believe him. Like she has a face. She's like, "What? What are you saying?" And he's like, "Well, we print it digitally, but we print it. That's what they do. They just print. They just print the money, and thus you are diluting the money stock, right? You are expanding the size of the money stock, and whoever is not getting a bigger share of the money stock is losing." So some argue also, this is important, some argue that government, because of the constitution, could print its own money, get this, by having the US Mint create a platinum $1 trillion coin, a platinum coin. And I'm kind of being sarcastic here. I'm not erudite enough to understand this. Like, what is going on? Like, you want to no. But anyways, if that makes any sense, like if a government can do that, which they've been thinking about doing multiple times, and the government anyways prints so many issues so many treasuries that are bought by printed money, then you almost wonder the role of taxes. There's no role for taxes if governments can just print money to finance everything. I mean, it makes very little sense. So anyways, that is the state that we're in. And so in conclusion, to answer that question, what is debt? And again, very fundamental video, but I think it's important before I go on with the series. What is debt? Well, debt is what? Debt is loans. Loans make deposits. So when you have debt, you're creating new money supply. When you go borrow money to buy a car, or when you go get student loans or whatever, you're creating new money. That money is created out of thin air. So money starts its life as debt first, not as a commodity like gold. Money starts its life as debt, and it's simply an entry on a bank's ledger, and then it is deleted when it is repaid. And then this is where it gets important. There is no limit to money creation by commercial banks. As long as a commercial banks find someone trustworthy to be trustworthy, they can lend to that person. And the reserve requirements that the Fed used to have, they still don't have. And the Fed sets higher interest rates to discourage borrowing. But banks create money. And if you go see a bank and if you fit the bank's requirement, they will create that new money supply to lend you the money. And then you have to pay it back based on how much they trust you to pay it back. But of course, this whole system compounds because one's trustworthiness is probably assessed based on trustworthiness that was already given prior, if that makes any sense. Like if you have a stock portfolio composed of a bunch of bonds that have been issued prior, the bank decides to lend you on those bonds. So the bank takes someone's debt and uses that debt as a asset in its assessment of whether you are trustworthy enough, of an assessment of whether you can actually go ahead and borrow. So old debts, old assets, all debts actually become assets that can be used by the bank to make an assessment onto whether they can lend new debt to you. So debt is kind of cumulative and additive, which is really, really, really crazy when you think about it. And that's why Warren Buffett's acolyte Charlie Munger said it a few years ago. Currency over 100 years, the only thing you can be certain of is that it's going to zero, because it's just debt on top of debt on top of debt on top of debt, and it's soft. Currency is soft. It's not hard. When the bank can create it whenever they see someone who's trustworthy, and by the way, their assessment of trustworthy depends on their risk tolerance too. You don't have any hard cap or any hard limit of how much money you can create. So The larger the amount of borrowed money outstanding, and the more you have monetary inflation, and that's the size of the money stock. So debt balloons. It never gets repaid. It always balloons. Like there's always more debt than is being issued than people are paying off all debts, because debt is one of the main ways that is used by fiat economists to grow the economy. Right? We count growth of the economy in GDP. And how do you increase GDP? Well, you have to increase debt. Um, and anyways, the size of money, this is a sarcastic question. Does the size of a money stock ever grow? Well, this is the question that I ask back: is do we ever have we ever decided to have a period collectively where the whole country decides to stop borrowing and decides to start paying it all off? Do we have that? Like, are we ever gonna have a period where we all say, okay, stop the excess now, no more borrowing, no more ballooning of debt, and we're all gonna be smart and sound, and we're all gonna start repaying our debts, beginning by the government, who has more than $1 trillion in deficit. So you would need to begin by cutting all government spending, essentially, and for like more than a decade, and maybe you would make a dent on government debt, but you would also have to have households agree to never ever borrow money again, at least for a sizable amount of time, for a lifetime, for the debt stock to reduce. So as long as new loans are granted, you will have more loans than you had in the past, and it just balloons, and you almost can't end it. It's impossible. That's why a lot of people are coming to the conclusion that QE to infinity is the only way, and we will come to a system of a new money that will be either based on a Bitcoin standard or on a gold standard, on something that is hard and cannot be created. And so, to answer my question, do we ever decide collectively to go ahead and pay it all off? And the answer to that is obviously not. So this is M2, and keep in mind, and I focused that on a lot of my prior videos, this does not include Eurodollars, this is just the US financial system. And you can see that it's just kept increasing like insanity. And if you chart this to inflation, this matches inflation really, 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 really well. And by inflation, I don't mean the consumer goods or the consumer basket of goods. No, I mean actual monetary inflation. That is monetary inflation. And you can see that also for national debt. National debt surpasses 31 trillion. And so the question is, are we all going to decide right now, and is our government going to decide right here, that now's the time that we pay off the debt? And if we start paying off all of that debt, inflation will go away. If you start paying off the money stock, if M2 starts getting paid off, all of a sudden you have a smaller money stock and your dollar gains value. But it's very unlikely that it will happen, especially when you know the link between the two, because the US national debt is largely financed by the Fed through the creation of base money. So I hope this was interesting. This is the first video in my series, What is Debt? This whole line of thinking is the reason why the channel is named Beat the Denominator. None of this has been investment advice. This is just entertainment, only entertainment. Thank you so much for your support. Thank you for watching. Thank you for liking, and thank you for subscribing. And if you can follow me on Twitter, I really appreciate it. Thank you, and have a great day.